Operating cost is a cost incurred conducting a business activity. Operating cost refers to the cost of undertakings, which do not manufacture any product but which provide services. Industries and establishments like powerhouse, transport and travel agencies, hospitals and schools which undertake services rather than manufacture of products. Ascertaining operating costs. The cost and units used are kilowatt hour. It means kWh, passenger kilometer and bed in the hospital, etc. More. Operating costing method constitutes a distinct type of costing, but it may also be classified as a variant of process. Cost since cost in this method are usually compiled for a specified period. Contract costing. Contract costing is the costing of a contract with some terms and conditions between contractee and contractor. This method is used in the undertakings carrying out building or constructional contracts like construction engineering concerns, civil engineering contractors. The cost unit here is a contract which may continue over more than one financial year. Joint costs. Joint costs are most cost of facilities or services employed in the input of two or more simultaneously produced or otherwise closely related operations, commodities or service. When a product process is such that from a set of same input or some distinguishably different products are produced together. Products of greater importance are termed as joint products, and the products of minor importance are termed as byproducts. And the costs incurred prior to the point of separation are called joint costs. For example, in petroleum industry, petrol, diesel, kerosene, naphthana for is produced by jointly in the refinery process. Byproduct cost. Byproduct cost is the cost assigned by to the cost assigned to by products till the split of pointing. Classification by time. A cost item is related to a specific period of time, and cost can be classified according to the system of assessment and specific purposes as indicated to in the following some ways. It's been classified by terms: historical cost, predetermined cost, historic cost one side, and predetermined cost. It means two types: standard cost, estimated cost. Historical costs, it means their actual costs of acquiring assets or product producing goods or services. They are post modern costs ascertained as after they have been incurred, and they represent the cost of actual performance, actual operational performance. Historical clear costing follows as a system of accounting to which all values are based on costs actually incurred as relevant from time to time. Predetermined costs. Predetermined costs for a product are computed in advance of production process on the basis of a specification of all factors affecting costs and cost data. Predetermined costs may be either standard or estimated. Standard costs. A predetermined norm applies as a scale of reference for assessing actual cost, whether these are more or less. The standard cost serves as a basis of cost control and as a measure of productive efficiency, which ultimately posed with an actual cost. It provides management with a medium by which the effectiveness of current result is measured and responsibility of deviation placed. Standard costs are used to compare the actual cost within the standard cost within the view determine the variances, if any, and analyze the causes of variances and take proper measures to control them. Next, estimated costs. Estimated costs of a product are prepared in advance prior to the performance of operations even before the acceptance of sale orders. Estimated cost is found with a specific reference to product in question and the activity levels of the plant. It has no link up with actual, and hence it is assumed to be less accurate than the standard cost. Technique of costing. Marginal cost, standard cost, budgetary cost, and uniform costing. See, marginal costing is the ascertainment of marginal costs and the effective on profit of changes in value or type of output by differentiating between fixed costs and variable costs. Several other terms is used like direct costing, contributory costing, variable costing, comparative costing, differential costing, and incremental costing are used or less synonymously with the marginal costing. The term direct cost should not be confused with the direct costing. In absorption costing, direct costing refers to the cost which is attributable to a cost center of cost unit. Example: direct labor, direct material, and direct expenses including traceable fixed expenses. The fixed expenses which are directly chargeable. In direct costing or marginal costing, factory variable overhead is taken as a direct cost, while in the absorption cost method, it is indirect cost. Standard cost is defined as the preparation and use of standard cost. Their comparison with the actual cost and the measurement of and analysis of variances to their causes and point of incidence. Standard cost is a predetermined cost unit that is calculated from the management stance of efficient operation and the relevant necessary expenditure. Standard costs are useful for the cost estimation and price quotation and for indicating the suitable cost allowances for our products, process, and operations, but they are effective tools for cost control only when compared with the actual costs of operation. The techniques of standards costing may be summarized as follows. Predetermination of technical data related to the production, details of materials and labor operations required for each product, the quantum of inevitable losses, efficiencies expected, level of activity more. Predetermination of standard cost is full details under each element of cost, labor, material, and overhead. Comparison of the actual performance and cost with the standards and working out the variances. The difference between the actual and the standards. Analysis of the variances in order to determine the reason of deviations of actual from the standards. Presentation of the information to the appropriate level of management to enable suitable action. Remedial measures or revision of the standard being taken. Budgetary control. Budgetary control may be defined as the process of continuous comparison of actual costs and performance with the pre-establishment budgets in a relation to the responsibility of the executives to the specific budgets for the achievement of a target in accordance with the policy of the organization to provide a basis for revision of budget. Therefore, budgetary control involves mainly establishment of budgets, continuous comparison of actually with the budgets of achievements of targets, revision of the budgets in the light of charged circumstances. The classification of budgets into various categories certainly helps to make the budgetary control more effective because the maximum use is made of the functional budgets. Functional budgets over the goals to be attained by the functional executives and thus assume the greatest signification. Uniform costing. Uniform costing may be defined as the application and use of the same costing principles and procedures by different organizations under the same management or and on a common understanding between members of an association. It is thus not a separate technique or method. It is simply denotes a situation in which a number of organizations may use the same costing principles in such a way as to produce costs which are of the maximum comparability. From such comparable cost valuable conclusions can be drawn. When the uniform costing is made as use of by different concerns, the same management it helps to indicate the strengths and or weaknesses of those concerns. By the studying the findings, appropriate correctiveness steps may be taken to improve the overall efficiency of the organizations. When used by the member concerns of trade association, uniform costing helps to reduce expenditure on a comparative marketing to determine and follow uniform pricing policy, to exchange information between the members for comprised and more improvement, and so on. Interform comparison, as the name denotes, means techniques of evaluate and performances, efficiency, defeats efficiency, cost and